In recent years, cryptocurrency has emerged as a disruptive force in the financial world, challenging traditional currencies and financial systems. The decentralized nature of cryptocurrencies, such as Bitcoin and Ethereum, has captured the imagination of investors, entrepreneurs, and technologists worldwide. However, this transformative technology has also raised critical questions about government regulation and oversight. In this extensive exploration, we will delve into the complex and evolving relationship between cryptocurrencies and governments, offering a global overview of the various approaches and challenges in regulating this digital financial frontier. Cryptocurrencies are digital or virtual currencies that use cryptography for security and operate on decentralized ledgers known as blockchains. This technology promises to provide greater financial inclusivity, transparency, and efficiency while challenging the existing financial order. Nevertheless, the absence of a central authority and the pseudonymous nature of cryptocurrency transactions create a regulatory conundrum for governments worldwide. The global perspective on cryptocurrency regulation is far from uniform, with each country adopting distinct approaches that range from outright bans to embracing and regulating these digital assets. For a comprehensive overview, it is essential to examine the policies and practices of various nations. China, for instance, has taken a proactive stance in cryptocurrency regulation. In September 2017, China banned initial coin offerings, ICOs, a fundraising method that involves creating and selling new cryptocurrencies. The country later extended the ban to cryptocurrency exchanges, effectively shutting down domestic platforms. The Chinese government cited concerns about financial stability, fraud, and money laundering as the reasons behind these stringent measures. In contrast, other countries, such as Switzerland, have adopted a more permissive approach. Switzerland is often referred to as Crypto Valley, due to its friendly stance towards blockchain and cryptocurrency companies. The Swiss government has developed a clear regulatory framework for cryptocurrencies, fostering an environment that attracts blockchain startups and investment. The United States, as a global financial powerhouse, plays a pivotal role in shaping the regulatory landscape for cryptocurrencies. U.S. regulation varies at the federal and state levels, resulting in a complex and evolving regulatory framework. The Securities and Exchange Commission, SEC, for instance, has classified certain cryptocurrencies as securities, subjecting them to specific regulations. Additionally, cryptocurrency exchanges are required to register with the Financial Crimes Enforcement Network, FinCEN, as money service businesses. This patchwork of regulations has left both industry participants and regulators grappling with compliance and enforcement challenges. Japan, on the other hand, took an early lead in cryptocurrency regulation by recognizing cryptocurrencies as legal tender. This move provided clarity and legitimacy to the cryptocurrency industry, encouraging its growth. Japanese authorities established the Japan Virtual Currency Exchange Association, JVCEA, to oversee the industry and set regulatory standards. The regulatory landscape in South Korea is a dynamic one. The country has experienced the rapid growth of the cryptocurrency market and, in response, implemented a range of measures. These include banning anonymous trading accounts and requiring exchanges to comply with Know Your Customer, KYC, and anti-money laundering, AML, regulations. India, one of the world's largest economies, has grappled with the question of cryptocurrency regulation for several years. The government has gone through periods of uncertainty, proposing bans on cryptocurrencies while simultaneously exploring the development of a digital rupee. This wavering stance has left the Indian cryptocurrency community in a state of limbo. In Europe, the regulatory landscape is a tapestry of approaches. Some countries have embraced cryptocurrencies, while others have taken a cautious approach. The European Union, EU, is working on a comprehensive regulatory framework that would provide legal clarity and consistency across its member states. This framework seeks to address issues such as consumer protection, market integrity, and AML regulations. The approach taken by governments toward cryptocurrencies often hinges on their perception of the risks and benefits associated with this technology. On one hand, cryptocurrencies offer the potential for financial innovation, financial inclusion, and borderless transactions. On the other hand, they present regulatory challenges in terms of investor protection, financial stability, and the potential for illicit activities. Regulatory challenges encompass a wide range of issues. A major concern for governments is the potential for cryptocurrencies to facilitate money laundering and terrorist financing. The pseudonymous nature of cryptocurrency transactions can make it challenging for authorities to trace the source and destination of funds. Taxation is another area where governments grapple with cryptocurrency regulation. Determining how to tax cryptocurrency transactions and holdings is a complex task. It requires developing tax policies that accommodate the unique characteristics of digital assets, such as their extreme volatility and the potential for capital gains. The volatility of cryptocurrency prices is a source of concern for both regulators and investors. Price fluctuations can result in significant financial losses for investors, leading some governments to implement investor protection measures and risk disclosures for cryptocurrency investments. The lack of investor protection is an issue that has gained prominence with the proliferation of fraudulent initial coin offerings, ICOs, and Ponzi schemes. Regulators seek to protect investors from fraudulent activities while fostering legitimate innovation. Market integrity is another critical aspect of regulation. Ensuring that cryptocurrency exchanges operate transparently, securely, and fairly is a priority for many governments. Exchanges are often required to meet specific security and compliance standards to prevent hacking and theft. The question of whether cryptocurrencies should be classified as securities has been a contentious one. Some governments have chosen to regulate certain cryptocurrencies as securities, subjecting them to stringent rules to protect investors. This approach, however, has been met with resistance from the cryptocurrency industry. The adoption of cryptocurrencies in the financial industry has also necessitated regulatory responses. Cryptocurrency trading, custody, and other services are increasingly integrated into traditional financial systems, raising questions about how these services should be regulated. Central bank digital currencies, CBDCs, are another aspect of the cryptocurrency ecosystem that has garnered significant attention from governments. CBDCs are digital representations of a country's fiat currency and are issued and regulated by the central bank. These digital currencies are seen as a means to enhance financial inclusion and efficiency while allowing for greater control and oversight. Governments around the world are exploring the potential of CBDCs and their implications for the financial system. China, for instance, has made significant progress in developing its digital currency, the digital yuan, which is already in use in pilot programs. Other countries, such as the European Central Bank, ECB, and the US Federal Reserve, are conducting research and experiments with CBDCs. The advent of decentralized finance, DeFi, further complicates the regulatory landscape. DeFi platforms enable peer-to-peer financial services without the need for traditional intermediaries. These platforms raise questions about how existing financial regulations apply and whether new regulations are needed to address the unique risks and opportunities presented by DeFi. The pace of technological innovation in the cryptocurrency space has often outstripped the ability of regulators to keep up. New developments, such as non-fungible tokens, NFTs, and blockchain-based governance structures, continue to challenge the boundaries of existing regulations. Some governments have recognized the need for a balance between innovation and regulation. They seek to foster innovation in the cryptocurrency space while implementing safeguards to protect consumers and the integrity of financial markets. The notion of regulatory sandboxes, which allows startups and innovators to experiment within a controlled regulatory environment, has gained traction as a means of striking this balance. The international nature of cryptocurrencies has also led to the need for coordinated global regulatory efforts. The Financial Action Task Force, FATF, an intergovernmental organization, has provided guidance on AML and counter-terrorist financing measures for cryptocurrencies. However, achieving consensus on international regulations remains a formidable challenge. In the realm of cryptocurrency taxation, governments are developing various approaches. Some countries tax cryptocurrency gains as capital gains, while others treat them as commodities or property. The lack of a globally harmonized approach to cryptocurrency taxation poses challenges for cross-border transactions and compliance. The question of how to enforce cryptocurrency regulations poses unique difficulties. The decentralized and pseudonymous nature of cryptocurrencies can make it challenging for governments to monitor and control transactions effectively. Regulatory enforcement often depends on the cooperation of cryptocurrency exchanges and service providers. Privacy is another critical aspect of the cryptocurrency regulatory landscape. Privacy coins, such as Monero and Zcash, are designed to provide enhanced privacy and anonymity in transactions. The use of these coins raises concerns about the potential for illicit activities and the challenges of regulation. Cryptocurrency advocates argue that the technology has the potential to empower individuals by providing financial autonomy and access to the global economy. They assert that overly restrictive regulations can stifle innovation and hinder financial inclusion. On the other hand, critics of cryptocurrency regulation point to the technology's association with illicit activities, including money laundering, tax evasion, and cybercrime. These concerns underline the need for governments to strike a balance between fostering innovation and protecting the public interest. In summary, the regulation of cryptocurrencies is a complex and multifaceted challenge. Governments around the world are grappling with how to balance the potential benefits of this technology with the risks it poses. The evolving regulatory landscape reflects a global recognition of the transformative power of cryptocurrencies and blockchain technology. As governments continue to adapt their regulatory frameworks, the outcome will shape the future of finance and the global economy. Cryptocurrency regulation remains a dynamic and evolving field, and it will continue to evolve as governments respond to the ever-changing cryptocurrency landscape.